and flatbed insanity. To the HPLS podcast. Live, relevant, and high performance information, conversations, and education weekly. Y'all, that was pretty close to like a total radio voice, eh? And flatbed insanity. Good morning. Actually, so we have. Hold on.
Lisa.
So we've got. Good morning, Lisa. Beat Jeff again, and then try to come back for a second round on it.
Lisa might just be on our show every Friday soon until we get some swag.
I think Jeff is sleeping in or something. Something's going on, man. You know, but guys, listen. Data Day Wednesday, another awesome day. It's going to be today. Buckle in. If y'all don't have a coffee, go get a coffee because Dean's about to hit you dead smack in the forehead with some serious information. Just the 30 seconds we talked before we got on, it's like, holy crap, that's huge. So, yeah. Dean, I will let you take it away because there's some very interesting information about flatbeds and oil rigs and all that we want to get into today.
Yeah, we do. Maybe if I could give you a little bit of a teaser for next week's show.
Yes. Oh, I like it. Starting with the teaser.
Yeah. Shanghai has reopened, as you've heard.
Yes.
And which is great news. And given the incredible efficiency of the Chinese at loading and unloading 24/7 in some of their really automated ports, I expect this backlog to start clearing pretty quickly. I counted the number of vessels at anchor this morning, and it was 325 little dots on a map. And
so you mean we got container getting happening here in 30-something days?
Well, it's interesting.
You call it container getting? I like that. Yes, container getting's coming.
It's 324. So it's 324. 2 weeks ago, it was 425. So it's down 23% in the space of 2 weeks. So that backlog will clear pretty quickly. Great story in JOC today. They said that about 12% of the world's ships were stuck outside of congested ports. But the number of the day that blew me away was that as of January, there are about 50.5 million containers available in terms of available container capacity. 50.5 million as of January. It's a lot of tea a year, a lot of containers.
Yeah.
But that's 8 million more than before the pandemic.
So hold on. Meaning that we're available.
Containers is what you're saying. Yeah.
We've got 8 million more containers in the market than we did before the pandemic.
Wow. I thought you meant available before the pandemic. I was like, okay, so how many did we put in the market?
So there's another 8 million in terms of capacity being added, but with about 12% of the ships tied up at ports, we've still got a lot of dwell time for containers. So, it's like chassis trailers. We've added a lot more chassis trailers to the market. The intermodal carriers are adding a lot more 53-foot box vans. Carriers can't buy trailers. I wonder if we end up like some of the big box retailers where they're now having pretty significant sales on this inventory they've been building up. If we just don't end up with a lot of equipment laying around eventually when things do come back to normal. That's if they ever do. But
that's such a great point, though, Dean.
Isn't that interesting?
I could see that.
How cyclical this industry is, right? Yeah. Thankfully, this is weird, but we haven't been able to get new trucks out of factories. Otherwise, this would be a real calamity if the truckload industry had been able to get the equipment out of the factories, because we have way more.
I think that people learned from 2018-19 when it came to like progressive, like massive growth over a year. And do you not think, like, I mean, a lot of the people I speak to, they're like, yeah, we're adding new equipment, selling the used equipment because they're getting a really good price for the used equipment, but we're not going as aggressive as we did in like 2018 because as much as I think higher rates are here to stay for the overall industry. There's still going to be the bottom feeders that are going to drive rates down, right?
Of course,
there will be carriers. Mm-hmm. They're doing that now, so that's just a race to the bottom. Mm-hmm. But I think that we did, our colleagues at MIT did a study, on whether, we talked about this a while ago, whether shippers and carriers were goldfish or elephants in terms of their memory. Well, it turns out shippers are elephants and carriers are goldfish. So they have a very short memory.
That's true.
Just keep running into that glass wall.
Yeah,
just keep hammering down that left lane. Like I can see that, because for a carrier, there's more urgency to put revenue on the truck.
Yeah,
you can't sit for a day, because every day you sit, you've got fixed costs of $240 a day per truck just building up. So you've got to run. Otherwise, your rate the next day has got to pick up the $240 slack from the fixed cost the day before.
Yeah, which
is a bit different for a shipper, right? They've got a much more bigger player. Anyway, so that was a tease for next week, because I'll do a lot more counting of dots on maps between now and next Wednesday to see how quickly the 324 dots on the map off Ningbo and Shanghai this morning, how quickly that drops. Yeah. And what that means is the average transit time, and I'm giving away some of our data from next Wednesday, but the average transit time from exporter in China to importer in the US is 45 days. Normally, it's at 100 plus days now.
Whoa. Hold on.
Yeah, hold on.
So by the
when
time
we used to come out of China, when we came out of Ningbo, it was about 31 days on the ocean.
Yep.
And then it would hit port, and then it would rail in, and we would be receiving them in about 38 to 45 days, depending on the congestion at the port. So you're telling me the 31-day transit, or whatever it is, 35-day to get to the port, and then we're adding another like 50, 60 days to actually get it to door?
Yep. Wow. There's a lot of congestion at the port still. Dray capacity is very tight. Rail equipment's very tight. Don't forget, the railroad industry have probably as big a shortage of employees as anybody. They furloughed a lot of people. They're down by according to my experts, about 30% in terms of the number of engineers they really need. So they're struggling to bring back engineers to run their equipment, and that's a bigger issue than the truckload industry's faced. So there's still a lot of inland congestion in the US, even though there's port congestion has been very topical. Getting things moved throughout the country is still problematic. We're still not back to normal. So when we started the year and said this year will be much the same as last year, we're already at June. It looks like that's going to play out pretty much. It's going to take a long time for supply chains to get back to normal, which is what we said a month ago, right? If you're talking to your customers, be prepared for more of the same. So anyway, that was
it's interesting, because with that delay, you think about it, if your container leaves today, you're not going to see that product until probably September.
Right.
Yeah.
That's crazy, because you're putting the money out.
So what is that stuff even for? What season is that for? I mean, what
you're importing for Christmas right now.
Yeah, it's got to be Christmas.
It's like a story on the head of a logistics firm yesterday, GXO, I think it was. He said that, the headline was that people are ordering now just in case, as opposed to just in time, which makes sense. But the general theme of the interview on CNBC was that, the peak season normally starts in June. This year, orders went out mid-May for the peak holiday season for back to school and all of that inventory they want to get in for the end of the year. So there's going to be a lot more pull forwarding of inventory and flattening of what we would normally see as a peak season truckload volume. It'll be pretty flat but consistent, which is exactly what it was second half of 2020 and last year. It was a much earlier pull forward, and that cyclical seasonality increase in volumes that we predictably used to see kind of disappeared. So we're still not back to any form of seasonality in that regard just yet. Lots more disruption.
And not only that, companies that wanted to try and get rid of warehouse space are probably going to need more warehouse space.
And Dan, I'm so glad you said that. I was thinking the same thing with everything coming in and the delays that it's taking. Do you think that's
this will be a conversation for tomorrow, DJ? So we got Greg on tomorrow, right? Greg Cornett.
Yeah, we need to.
And Greg was explaining to us last time he was on 2021 compared to 2020. And 2020 had no outside warehouse space. In 2021, he had 1.3 million square feet. 1.3 million because they're bringing so much product in. So for example, when Shanghai shut down, because he imports everything, right? Like they do not manufacture anything in the US. He imports everything. So like I just had a conversation with him last week, and he goes, no, all our inventories are fine, because before Shanghai got shut down, they had all their product in because they have 1.3 million square feet of warehouse space outside of what they normally have. So
didn't think that way.
So they've increased their warehouse. They've increased their product here their supply. So when things like that happen overseas, they're good. They can still serve their customers. And this is what the majority of companies went to. And hence the reason like warehouse space is gold. Like I had a customer just 2 weeks ago. Yeah, 2 weeks ago, I had a customer that said, I'm looking at 5,000 square feet. And I said, okay. I call my main guy who's got millions of square feet. And he's like, yeah, I got 6,000 square feet left in one of my buildings. He goes, are you interested? I went back to the customer. The customer dragged their feet. 3 days later, I went back. It was gone.
It's gone.
Gone. And that's like 1.6 million square feet this guy has to the rafters. He goes like, I'm bursting at the seams. He goes, if I could literally find a shed right now, I would put freight in a shed. Like that bad.
I'll tell you that must be why these commercials are now advertising using your garage as storage.
Yeah,
you can actually rent out your garage as storage.
That's why there's a shortage of roller doors.
Yeah,
that's it.
Yeah. Well, and when you think about it, right? Like you put up like one of those big dome driving ranges. I guarantee you'll fill it with freight in no time.
No time. Just start advertising.
Right. So Nerf says, "Good morning, Nerf. Good to see you again, brother." Jeff, you're awesome. We're screwed. I've been preaching this.
I agree, Jeff.
It will bring us into peak season. Put your seatbelt on, folks. We're going to be on one hell of a ride. Good morning, David. How you doing, my friend?
Morning,
so Dean, let's dig in here, brother, because this is serious stuff. This is cool.
So interesting couple of weeks, right? Despite all the doom and gloom and the Chicken Littles of the world saying the sky is falling and we're heading to a freight recession, it's anything but in the flatbed sector. Their rates have been holding very firm, up and down one week, down the next. If I give you some perspective of where spot rates are in the flatbed sector, even though dry van and reefer have been heading down, I'm going to say for the best part of 9 months, flatbed rates have kind of been bouncing around this 265 to 270 line haul, excluding fuel. So about 265 to 270, up a penny, down a penny, week over week. So they've been kind of bouncing around, been going up for the last 3 weeks. So if you all remember 2018, which was our last big industrial economy rate rally in the freight market, it was a big flatbed market in 2018. Rates today are still 30 cents a mile higher than 2018.
Wow.
So remember, we've had a consumer-driven economy for the last 2 years, roughly, because of the switch to buying online and all of those other things we've talked about. But the industrial economy, I think, really speaks to how strong the flatbed market's been. Because flip that around the other way, I think the strength of the flatbed rate market tells you a lot about the strength of the industrial economy and the housing market. And I think it's an important point that most people missed. And we've seen nothing but strength in the flatbed market. There's still, the flatbed rates were like $1.90 back in 2019, right? So remember when there was lots of bankruptcies and the rate was going down and people were shedding a capacity. So 19 rates were $1.92, and in 2018 they were $2.34. So we're about 30 cents a mile better than we were in 2018. Just to put some perspective around all of the doom and gloom that's been going on, because there's, what we're seeing is that consumers aren't switching away from buying goods, flipping to services as much as we would have thought. That hasn't happened yet. It certainly hasn't happened in the April data in terms of durable goods spending. So, and I pulled some data this morning, just, to give you a sense of where we think demand is for flatbed carriers. The number of steel tonnage, according to Standard & Poor's Platts, this is the volume of steel produced every week. It's up 1% in the last month. Not huge numbers, but it's significant. At least it's heading in the positive direction.
At least it's gone up.
Right? But the headline story that we started the show with, of course, and our trend for today is we're drilling more holes in the ground for oil and gas. And think about, the Baker Hughes rig count comes out at 1 p.m. every Friday. It's a really good data point you all should subscribe to, but it tells you about flatbed demand for casing and drill pipe and other things that flatbed carriers haul, machinery, pumps, all those things. Not to mention all the dry bulk cement that goes in the powder tankers. What would you call them here? Pneumatic tankers that haul cement.
Yeah.
Yeah, they pump into
cement trucks.
Sand. I used to drive one. We call them powder tankers in Australia. Anyway, so if you think about all the stuff that goes into drilling a hole, the Baker Hughes, Halliburtons of the world, Schlumberger, all those companies that do all the drilling, and then they go in and log the well, and then they do all the other stuff that comes after it. The number of wells being drilled in the market is up 69% year over year. So we've gone from something like 424 rigs this time last year to about 725 rigs today. So we are drilling more holes. We are adding more rigs. We are adding more capacity. It obviously is not quick enough because diesel prices are still ridiculously high, even though they came down, 5 cents? What was the number yesterday? I'll quickly look it up. Down 3.2 cents to 5.54. Still ridiculously high for carriers.
Yeah.
So if you look at one of the markets we look at in the flatbed market, our biggest market for spot market and contract market volumes is Houston. So Houston is the epicenter of oil production, chemical production. Pipelines come in there from all over the country into the Gulf, and then it gets exported or redirected to the East Coast or the West Coast. So it's kind of, when you look at where all the rail lines come from, the oil fields, whether it's Eagle Ford, Oklahoma, North Dakota, the Permian Basin, a lot of that volume comes into Texas, in addition to Texas being a big producer of oil rigs. So one of the things we see out of Houston is a really strong correlation with spot rates and truckload volumes on lanes like Houston to Lubbock, which is kind of in the heart of the Permian Basin, where about half of the oil rigs are located. Mm-hmm. So it's a really good way to say, take the pulse of the flatbed market, notwithstanding the fact that, people are hauling a lot of steel out of Gary, Indiana into Pittsburgh, and we're sending there's a lot of lumber coming out of Quebec and Ontario into, New England. Of course, out of the other big freight market for softwood lumber, of course, is British Columbia, and then Medford, Oregon, and Portland. There's a lot of softwood plantations up there. So, but they're hard to get to for carriers, right? Because there are a lot of freight goes north but not south. So there's an imbalance. So you see a lot of rate volatility out of some of those markets where you've got long distances. But I pulled some numbers this morning, the other one before I get into oil, machinery. So you think about farm machinery. A lot of flatbed carriers can haul, 100 horsepower tractors, farm orchard tractors, right? When you get into the self-propelled combines and the four-wheel drives, you're talking drop deck without riggers and ramps, right? So when you look at total tractor sales, and this is why I think everybody needs to rethink year-over-year comps. 2021 is a real outlier. The more this year goes on, the more 2021 data is a really terrible year to compare anything to, because it was such an extraordinary year, whether it's produce or machinery. And I'll give you an example. This is a really good data point from the Association of Equipment Manufacturers, the AEM. They produce a great report each month on the total sales of 100 horsepower, 200 horsepower, 400 horsepower, four-wheel drive and ag combines. Total machinery sales are down 22% year over year. You would say, wow, the sky is falling. Just like produce volumes are down about the same amount year over year, but they're still they're still just above the 5-year average. For April.
Because last year was an anomaly when you're comparing year over year.
Yeah.
Right. So, and in the 100 horsepower range, which is like a 100 horsepower tractor is a lot of, small farms. Mm-hmm. I think there's a lot of people who've moved to rural areas and bought tractors and started farming and tinkering around. I can see that happening, right? So those sales are up 4% year over year. So, you can tell any story you like with data. I think you've got to put things in perspective. And one of the things I've realized is that it doesn't matter much what data set I look at. 2021 was such an outlier, and it's a really bad year to make comps to. But if you've been listening to my show and this show, you will hear me always comp this year to 2018, because that's the most closest year we've got where it was a sort of a bull market in freight terms, but it was also a year when capacity was tight. And that's sort of it looks like in flatbed 2022 looks a lot like 2018. Of all of the last 6 years, it looks very much the same when you look at the number of flat. And I'll tell you, this is always a good way to figure out how healthy is the flatbed market, and it's the volume of load posts in each week. And the load post flatbed market It's only 7% lower than this time last year in flatbed, but it is 37% more than 2018.
Wow.
So 7% lower, and here's kind of where my brain's going, as I'm listening to the data, Dean.
Yeah.
So twofold. There was the infrastructure bill that came out 2020, I believe it was, where there was like $2 billion or $3 billion put into infrastructure in the U.S., and you equated that to like 200,000 truckloads,
something like that,
a year or something. Yep. I remember there was some math that we did there. Then I look at the fact that, you look at the housing market is real strong. Well, people need to move in. When they move into their homes, they need to buy stuff for their homes, which is then going to create an increase in the next side of it, which is the home consumer goods and all this kind of stuff. A lot more people working from home, more purchases of computers, which then, I could talk personally. I'm hoping to get my new computer over the next 2 days. I ordered it 5 months ago, like literally 5 months ago, I ordered it. And it was transistor, this issue, that issue. Yeah, it's been crazy. I mean, it really has been in 4 months ago, not 5, 4 months ago.
Right.
It's actually been insane. But I see a lot of these things starting to hit now, which I see will be an increase on OTR to get, final mile, to get things where they are.
Right.
All of this equates to a very strong market, I think, for almost any position you're in. And it's funny. Gentleman came to the door because we're in election up in Canada. I think it's midterm. I don't think it's so we're no, actually, I think, I don't know. Anyways, I know that's horrible, isn't it? So he came to the door and he says, one of their pitches for the Green Party was, we're going to keep a lot of the farmland. And I said, it's interesting you say that. How are you going to do this? And he says, well, what do you mean? I said, well, I look at it like this. We've been in a drought. Like, our summers in Ontario are, like, yesterday it was like 103. Like, you're literally using so much water just to keep your plants alive. Crops are like half, like, kind of same thing from California. Crops are not what they used to. Yep. Things aren't happening. I said, so you tell me how you as the government are going to keep farmland. He goes, well, what do you mean? I said, well, if I'm a second generation farmer or a third generation farmer, and I have 500 acres, and Mattamy Homes comes to me and says, I'll give you $40 million for your 500 acres. And I look at my $9 million in equipment, my crops at 60%, I'm struggling to keep things going. I'm going to take that 40 million and I'm going to say, thank you. I'm done. Right. Like, and especially because this is like second and third generation, the kids aren't necessarily willing to do this anymore. Right. Like, and again, certain ones are, but other ones aren't. And we're seeing more and more around my area. And I'm in the country where acreages are being sold, and it's like future development. They're just going to the city to wait. Right. And like, I think there's a boom coming. I really do, of people mass exiting cities and going into more country locations, which are going to create new cities. They're talking about a new highway in Ontario, the 413 going north, like north and then across over to Vaughan. And once that happens, that means you can get from the city to the rural country in like 2/3 of the time. It's going to create huge. So, but you look at that, you think of what it takes to build that highway. It's billions of dollars of investment. Like, you see massive construction everywhere we go. I think there's a tipping point that's coming. And I think it might be hidden from a lot of people. So for all of you out there in those industries, pay attention, because just what you said, you start getting that, then you start getting oil and gas prices drop. What's going to happen? People are going to start buying bigger trucks. Like, people are going to start buying trucks again. There might be a movement from electric to gas powered again. Like, all these shifts are very possible. Do I believe electric's going to take over? For sure, eventually. But you hear a lot of people, and if you pay attention to the stories, a lot of people are saying, oh, I'm going electric because gas prices are just out of this world. Okay. Understood. And trust me, I'm an electric dude. Like, I love electric vehicles. I've already ordered my F-150 Lightning whenever it comes, 5 years, whatever, down the road, whatever. I'm waiting for it. And that's what I want. But it comes to a point where is electricity going to be the price of fuel? Because everybody starts plugging in their cars, everybody starts using electricity in their home. Eventually, that's going to go up as well, right? Supply and demand. So that was my rant for right now.
Well, So very interesting times. I've just sent you some data we might be able to share with the folks to sort of talk about.
Dan, do you get internet delivered by truckload in order to have consistent connection out in the country? You can always count on you, Nerf. No, I do not.
Nerf,
it's delivered by straight truck because I don't trust OTRs and they're always late. Always lie to me. Can I share one more thing with you guys? So yesterday I went by a gas station and it was $2.25 a liter for diesel. If I do that by 3.84 liters per, it's $8.64 a gallon.
So I just seen on Fox News last night, reporter was at a gas station in Los Angeles. Regular unleaded was over $8. Diesel was $9.19.
Holy crap!
Whoa,
That's in Los Angeles. That was LA.
Wow.
Yeah.
Dean, let me pull up that slide you just sent.
Well, that's interesting. So the West Coast numbers on the EIA this morning were averaging 613. Well, there's some, I'm going to say price gouging. That's nuts.
Oh yeah, yeah.
Nationally, 554. East Coast is 584. So we're not far off $6 here. In fact, New England, where I am, is 623 a gallon average. That's incredibly expensive. Central Atlantic, 622. Yeah, there's some insane numbers in the market. I just sent some slides to Dan to talk about just to wrap up the 2022 not being a good year for comps. I don't know if you got that, Dan. The first one.
I'm exporting it right now.
Yeah, so the first one is the produce season, which is everybody's banking on the produce season being the savior of the reefer market. It's going to be a struggle. I think you might remember on our show a few weeks ago, my guess was rates would bottom out at some point and then kind of bounce around, and the peak in July 4 that we normally see each year wouldn't happen. It wouldn't be anything material. Well, truckload volumes are down 15% year to date. We're down about 31% year over year. That's a lot of truckloads. We're running less. We're probably sitting about 600,000 truckloads versus a long-term average. We're probably down about 100,000 truckloads a week nationally. These are so that's May would be that would be about right. But I think when you get that chart up, Dan, let me know. I think
so do you want the first one or the second one?
Yeah, put the first one up because this just shows you about how important it is to have a long-term perspective. The top chart is the national weekly refrigerated truckload volumes as reported by the USDA. So these are the volume, and you can see in June, right towards July 4 there, you can see the peak seasonally every year. But the red line, you can see we are sort of struggling to get going. It's been a really slow start. And that's why.
So red is present, right? Red is a present line that everyone's looking at?
Yeah, red is year to date, noting that May's numbers, there'll be still some late reporting of volumes because we're only just at the end of May now. So there'll be a lag there. That'll come up slightly. But you can see we're a long way off every other year. Like this is the worst start since 2015 by the look of the data today. So we've sort of got very low volumes, and that's why you're seeing such downward pressure on spot rates in the refrigerated sector. After going up a few pennies last week, they're down again this week. So it's playing out like we think rates will bounce around. I'm not sure we'll see the material spike that we see in June that we always do or around July 4. It's just not materializing at the moment. I think there's plenty of demand. I think we've got way too much capacity at the moment is what my sort of anecdotal, information tells me.
So Dean, this 31% down year over year, the USDA truckload weekly volume year over year. Yeah. So that's comparing to 2021, which was an anomaly, correct? So
correct. Yeah.
Is the May truckload volumes down 35% over the 10-year average? Do we have a 2018 to today? Oh, I guess we do.
Well, yeah, that's California.
Yellow. But what I was going to say, if you look at that top chart, Dean, the red is following below, but it's mirroring almost perfect the 2021 pattern. If you look at it,
yeah, just less of it.
Yeah, just a lot less, but it's almost like mirroring it perfectly.
Yeah, there's a lot of seasonality in what we do in produce in particular, because a lot of it's timed around obviously the weather, but also around seasonal events like, being cherries for Labor Day, and there's probably 1,000 other examples, but you know what I'm talking about. There's a lot of farmers time their crop harvest to take advantage of good prices around big events. So but I think the bottom point, Dan, the bottom chart is the point I wanted to make, and that is California. California May volumes are down 35% versus the 10-year average.
Yes.
We've only got citrus volumes in there for Q1, so that'll come up. But California, when you talk to brokers and carriers out there, they're off to a very slow start. Lots of issues. Long season last year, shorter season this year. Citrus volumes are predicted to be much lower this year. Drought and water restrictions we wrote about in my blog post about 3 months ago. Looked like there was, I can't remember the exact number, but it was in the six figures. I think it was something like 300,000 acres, fewer acres of planted cropland due to water restrictions. So it's having an effect. The broader picture is that, and this kind of supports the notion that spot rates won't materially increase in the refrigerated sector for the rest of the year. And I think the same will apply to dry van. They'll probably bottom out at around where they are now and then bounce up and down every week until, it's conceivable they'll be like this through certainly into the third quarter. So I just wanted to share that with you, Dan, because I think this is an important point. You can't look at year-over-year comps and compare it to 2021 and make forecasts and assume that things are much worse than they are, because in produce in particular, we're following season patterns, although it's lower. But 2021 is such an outlier, and I think that's the point I wanted to make today, was be careful about year-over-year comps. If you're talking flatbed, 2018 is your best year to compare to in terms of demand and rate directionality.
So, Dean, if I can ask a question, just because I want to clarify for myself and maybe anyone else watching or listening that has the same question. The USDA truckload volumes down 15% year over year. And the May truckload volumes are California down 35% over the 10-year average. Okay. So Okay. So the truckload 15% truckload weekly volumes, and then USDA truckload weekly volumes. Year to date 15%, and then the weekly volumes year over year for the month. Okay, got it. Okay. Now, how does that? Do you have any data on how that equates to 2018 versus today instead of year over year?
I'd have to rerun that, Dan. I could take that as a question on.
Do you want to go to slide 2?
I think this is probably a good segue to just talk about the broader picture and the impact of diesel. But this is a chart I pulled together for today for a group of investors with a large bank. And this to me explains why we won't see the mass exodus of carriers out of the industry, despite one of the biggest financial shocks in our history as it relates to diesel prices. Just for the viewers that can see the chart, the orange line is fuel as a percentage of revenue. So in the trucking world, when you run a fleet of trucks, and this is sort of comes from personal experience over millions of miles, if you can keep fuel at about 25% of trip revenue, you'll be profitable long term. Now, some loads will be 30% because you've got a heavy load and headwinds and you're climbing through the mountains. Other loads will be 20% because it's a light load, et cetera, et cetera. So if you can keep fuel at about 25%, you can see up until the pandemic, we were around 25%, maybe closer to 23%. And I highlighted the last two freight recessions, which was 2016. You can see it went up from about 20 to 23% in 16. In 19, it went up to 26%. And of course, we saw a lot of carriers exit the industry then. Today, it's sitting at around, what have I got there, 33%. So, but people say, oh, well, that's why everybody said the sky's falling and there'll be a mass exodus, and they use ridiculous terms like a bloodbath to generate clicks on their websites, just insulting to all the carriers that run profitable businesses. Because what everyone missed, not everyone, most, was that carriers came off one of the most profitable years in history, certainly since deregulation. And I highlighted the difference between fuel as a percentage of revenue that bottomed out at about 15% at the start of the pandemic, and how spot rates in the blue line took off from then all the way up to, this is trip revenue. I've taken off the number because I don't want to disclose our revenue per load. But that's where that gap, I mean, you can see it was an inversion in when the pandemic hit. I mean, there's only one other time where there was an inversion, which is back in 18. So fuel as a percentage of revenue was probably around 20% for the best part of, I'm going to say, a year at least. And that generated a lot of profit for carriers because fuel is, normally probably 45 cents a mile. Maybe it was 55 cents a mile a year ago. It's currently 85 cents a mile. So it's not insignificant. But carrier profitability has taken a hammering since Russia invaded the Ukraine. And it's dropped 56% year over year. Important to remember that spot rates are still high, compared to previous pandemic years, even though they've dropped. Contract rates are flattening out, although contract rates entering routing guides last week were about 8% higher than the week before. So contract rates are still, the new rates being negotiated are still coming into routing guides higher than the rates being used in the routing guide. New rates coming in are a little bit higher. Signs that it'll flatten and that market's peaking. So this is where carriers are at, and how a carrier survives. And you've heard them, Dan, you mentioned it. People have been selling their equipment. There's a lot of fleets that are, on their earnings calls have been reporting incredible profits because they've been selling their assets because prices have been so high.
Yeah,
I know owner-operators who've had 4 trucks and sold one and a trailer because the money was so good.
Yep.
So I think there's been, people are a lot better off now, despite, I know people are complaining and it hurts when you're paying $8 a gallon or whatever it is you mentioned in LA. Even if you're paying $6 a gallon, it's ridiculously expensive. And it feels like, the sky is falling. But the reality is carriers are coming off a really good financial year. They've got a much bigger buffer to wear this out. And of course, if diesel prices, drop dramatically and we somehow magically found a resolution to our geopolitical issues, things would return to normal very quickly, and a lot of this would go away. But that period in there where rates were higher than fuel for that extended period of time is why carriers have, when you hear a carrier say, I'm just going to park my truck and ride it out, there's a reason why they're able to do that now. Notwithstanding the percentage that Dan mentioned at the start of the show that have paid a lot of money for a used truck, probably double what they should have, don't understand their operating costs. They're paying $35,000 for insurance, no experience in the industry. Those guys are incredibly vulnerable. We're not saying nothing's happening, but I wanted to share those 2 charts with you just to give you a sense of, when you think about data and what people are telling you, you've got to be able to make sure you're looking at the big picture and taking in as much of the information as you can.
Yeah. So let's address something here because Kelly said, I disagree that people don't know. People know there is a tipping point. What we see what is happening. We just don't know when. It's not hidden. It's happening before our eyes. And I'm not sure I follow the disagree with that.
I agree. Well, it was you had made the comment that people aren't seeing what's going on. It was hidden. I think you had even said hidden. I think that's what in that. Kelly, just to in Canada, it is a little more hidden. I'm not going to get too political, but I just think it's a little more hidden in Canada than the US.
But here's the thing.
I'll just go there.
And I appreciate
that. We're not getting too political.
we have to understand something. Not every sales rep, actually the majority of sales reps. Now, Kelly, this might be your career and you might pay attention to data, but I'm sure if you do a poll of your office or your teammates or if it's employees versus agents, if it's dedicated agents, professionals versus just kind of spending time, the majority of salespeople don't follow the information you follow. Of course, Freight Waves is great. That's great. All these, all these companies that put information out, you have to be, and when I say great, I mean, I need to clarify that because they've brought information to the market, right or wrong and different. They've brought information to the market. Back when I first started, it was like Supply Chain Today was just starting. Logistics Management Magazine. Those were like the only 2 that were actually out. Information is, let me rephrase it. Information is more out there today for us to consume. The thing is, how do we apply the information? So it's great that people read it, but how they apply it. So if they don't apply the information, they still don't know, because they're not applying it to their business. So I hope that clarifies it.
I started something.
Hello.
Oh, okay. So here we go. Nerf. Our Prime Minister usually hides everything that is important from our country, so it makes sense why so many things are hidden. We are run by a master hider.
I agree, Nerf.
Not all political on us now.
Yeah, we're not going sideways though. Back to the chart. So that second chart, I will tell you. Yeah. So just being a chart nerd, I started doing day trading a little bit, and just watching that, you could see from December to February so December last year to February, they were the two patterns were mirroring each other. So you could tell. So if we were saying stocks, if we were using this as the stocks, go back to that other chart.
Yep. Which one? This one?
Yes, this one. So if you see toward the end, when we finally started to shift down, so they would say that in the blue chart, that was trying to break out of that 35% is what, again, if we're just talking stocks and talking patterns. So you see where it was trying to go above, the blue was trying to go above that 35, and the orange at the same time, so the fuel cost was trying to go even down at mirroring, and then they shifted. I think that will show you everything. Clearly, there is a lot of what happened, but then it's depending on what goes from there.
Well, there's we talk about on our DAT show on Tuesdays about this resistance level that rates have. There's a ceiling. It's an artificial ceiling, but at some point shippers say, "Yeah, I'm going to set it. I'm not going to send it. I'll find it. I'll find something else. I'll find a barge, or I'll find a train, or I'll do something different." And that we've seen that over 3 or 4 market cycles now, where there seems to be this inherent. That's not the right word. There's definitely a ceiling that rates won't go beyond. And in flatbed, we've kind of been at that ceiling. I thought we'd break through the 275 per mile ceiling a few weeks ago. It got close. It got within 3 cents of a mile of the record high last year, and then retreated. Wouldn't break it. So there's something to that, Dan. I'm pretty bad at investing, so I'm not going to jump into that.
No. And I'm a total rookie. I really dig the pattern, whole idea and breakouts and all of that stuff. So it's really cool.
So Dan, I didn't wrap up my flatbed and oil data set. We're good to bring it back to flatbeds from politics in Canada.
Yeah, get out.
I don't know. Nerf might bring it back, but go ahead.
It's my worst segue ever, but I'm not sure how to come back from there.
Yeah, I think there's no comeback. You just got to sever the head and move on.
So one of the data points I watch in our data sets is our rate view rates from Lubbock out to the Permian Basin. So Houston. So remember, the Permian Basin is about 43% of where about I'm going to call it 50%. It kind of goes up and down of where drilling rigs are. But if you look at from markets like Laredo to Lubbock, up 27% year. These are spot rates, up 27%. Laredo to Oklahoma, I think that's where the Eagle Ford Basin is, up 14% year over year. Most of your like Oklahoma City rates are up. So every market I look at where I want to look at spot rates, I can see that their flatbed rates are increasing, have been increasing for the last month at about the same pace that drilling rigs have been increasing. So Houston's spot market, the spot market for Houston is up 4 cents last week. It's up to $3.08. So think about $3.08. The national average for flatbed last week was $2.65. The average rate out of Houston is $3.08.
Holy cow!
Right, so
43 cents more.
Right, now it's up 9 cents in the last fortnight. It's been trending up on that particular lane. Out to Lubbock in particular. My internet slowed right down here this morning, so give me a chance. I'll see if I can pull it up. But so what we're seeing is that
talking about slow, it really went off the deep end.
He talked about his internet, and there it went.
Yeah, I think it was just it's funny, because you always have that like And then it's
yes.
like, oh, shit,
yeah, it's the orange. He must have got the orange starting to flicker and then cut it.
So
sorry about that, guys.
I think where Dean was going, and just a quick conversation. Oh, there he is. Perfect. Okay, good. Because now we can actually, Dean can jump in with the real data instead of us paraphrasing what we talked about before the show. Sorry, Dean, your internet's now good. I see green on my side. So
yeah, I'm not sure what happened there. So anyway, the broad. Where did we get to? What number did I leave you with last?
You were waiting on your internet because it had slowed.
Okay, all right. Well, I pulled up Houston to Lubbock, right? So Houston to Lubbock, if it's sitting at about $3.70 a mile. That's on one lane, right? So think about the national average was what, 265. Houston is 308. And then on Houston to Lubbock, where all the oil's being drilled in Texas, it's at 370 this morning. That's excluding fuel. So remember, including fuel, it's at 414. But excluding fuel, let's just talk about the underlying base rate at 370. That is 50 cents a mile higher than this time last year.
Wow.
So you think about the flatbed market. Looks like Dean gets his internet fired.
Hey, Nerf, I thought it was the government. I thought it was the government actually trying to.
DJ, you had to go back there. Come on, man.
Anyway, so just think about your dry van and flatbed. There's all sorts of volatility. Flatbed's been really, really consistent. There's a lot of steel and pipe and machinery and pumps and all sorts of good things. So we started off by saying that the total number of drilling rigs nationally is up 69% year over year. Well, flatbed rates from Houston to Lubbock, and if you sit out on I-35 like I've done, and do every time I'm down there, and I just watch flatbed after flatbed, drill pipe, casing, machinery, you would not believe the volume. And those rates, it looks like they're sitting at about 53 cents a mile higher year over year. The other thing I noticed, this is interesting in terms of economic viability, these weren't new trucks and trailers. These were trucks that were paid off 10 times over. And you could do a couple of trips a week and come back empty and make pretty good money and make a really healthy living, right? Yeah. So I think that's the part a lot of people, you kind of get, this is why you've got to weigh information on your own scales. Right? You've got to take in all of this information and put it on your own scales and figure out what that means to your market. But down there in that particular market, these guys have a lot of equity in their equipment. So they can afford to not take a trip or do a trip or run empty miles. Or there's a lot of owner-operators, a lot of small fleets that have a lot of equity in their equipment. And it's not, we aren't all large fleets that run on 3-year operating leases with pretty low margins where we have to lease, have to keep the wheels rolling and we have 85 to 100% driver turnover. That's not the majority of the trucks in the industry. The majority of the trucks in the industry are in small fleets. I think it's the same in Canada. Where they are viable, they are run by very smart, capable people, and they do have equity in their business and can withstand downturn like we're seeing now. Now the news doesn't report that because it's hard to. It's a fragmented industry. It's other than OIDA does a really good job at giving that section of the industry pretty good coverage and representation, but it's a really fragmented industry, and it's hard to get a handle on where they're at all the time. Because that's the beauty of the small fleet, in that they can meet supply and demand changes very rapidly.
And it's interesting. We had Chuck Snow on yesterday, and thank you very much for connecting us. By the way, Dean, amazing man. He was talking about before deregulation. Rates are like $6-8 a mile.
On deregulation, that was
miles. Yeah, I mean it was an awesome conversation.
Oh my goodness.
Yeah. Amazing man. And just his philosophy and his strategy and everything is so remarkable.
Right.
And it's interesting because you talk about being able to take time off or do empty miles because of the volume of rate that they get per mile. And it was kind of like what he was talking about before deregulation. He's like, you're doing a ton of empty miles, but you're getting like $6-8 a mile. So you can afford to do a ton of empty miles. And, obviously fuel wasn't what it is, but I guess from a variable, it was probably pretty close. Pre-fuel going up, right? Because you got to think you take the decades off in order, you know what I mean? So everything's kind of in that way. But, to start winding it down, what do you see as, the next, and I know you don't have a crystal ball. I wish you did, because man,
I feel like you do, Dean. I feel
like you do too. It's kind of like $1 billion crystal ball compared to anyone else in the market. You're more on top of it than anyone.
I agree.
But what do you see happening over the next, call it, and we'll continue this conversation, because that's the beautiful thing about data is it's not a one-time deal. It's a story that you have to follow.
Yeah.
How do you see the next couple of weeks panning out? The next, call it 8 weeks panning out, going into, summer and into then construction shutdown. Do you guys have construction shutdown in the US as well?
I don't think so.
No, we have an actual week at the end, I believe at the end of August, where we have literally a construction shutdown. Like everything in construction just shuts down. Yeah. It's because they typically go all year, right? So it's like they get their holidays and all that, and it's I think it's at the end of August. Do you guys not have that in the US?
No,
I don't think so.
It's an interesting question. I think we've probably touched on some of the themes earlier, where we're going to see produce season not deliver the goods in terms of upward inflection of dry van and reefer rates. I expect they'll remain flat for the next 2 quarters. That's typically what it looks like. Normally, this quarter is where carriers make a lot of money. A lot of small fleet carriers make money because they bank on produce season delivering a lot of volume, a lot of demand, and some incredibly high spot rates. So I just don't see that being the deliverer of all good things in Q2 that we would normally see. And if I could just give you a sense of where that is right now, I'll just pull up one of the benchmark lines I look at for produce season is Fresno to Hunts Point, New York. Hunts Point, New York is probably the largest produce market in the country. And Hunts Point, New York, 7-day rates are sitting at 223. Wow. This is nuts, folks. So if you could see this, you'd be blown away. But this time a year ago, excluding fuel, Fresno to Brooklyn, so Fresno is the biggest produce market on the West Coast by a long way, set up through that valley, up by 5. It was $3.44 a mile this time a year ago. Today it's $2.23.
Yikes.
Yeah. So that tells you that. So that goes back to our first chart about how California produce season is just not on fire. I shouldn't say that. That's the worst word to use in that state. But not delivering the goods, right? Rates are down. So when you think about, when I say reefer rates will kind of bounce around and not deliver the 4th of July peak that we normally see before they taper off, it certainly looks like there's not a lot of inflationary pressure on reefer rates right now based on the volumes. Volumes are down year over year, more like previous years. So again, we're coming off pretty bad comps. So you would say, well, why would you compare it to 344 last year? That's because last year was just insanely crazy in that market. So 223 is probably more normal, but that's why rates won't be up. I think the flatbed market is going to continue to be incredibly busy for months to come. Hurricane season started this week. So we're going to see a lot of demand. I think NOAA's predicting an above average season. These guys are dead on when they, again, terrible analogy. These guys are spot on accurate.
When you're talking hurricane season? Yeah.
I'm having a bad day. So hurricane season, they predict an above average season. These guys are spot on when they predict how many storms will happen. Again, a lot of we've had our first storm in the Pacific. It's in the Gulf now, and we've had our first named storm. So it's already starting. Yeah. This storm from the Pacific has looked like it's going to turn into some sort of a storm again in the Gulf. And
did you see that? Yeah, I've seen that.
So again, I think anyone in the southeast is going to have to get ready for a busy hurricane season. FEMA's going to pre-position a lot of trucks and trailers and loads in the Birmingham, Alabama market so they can get to the landfall.
So again, if you paid attention to, again, from a data perspective, the last major hurricane we had that hit the East Coast. And also, FEMA sucks up a ton of equipment. So that's something that people have to pay attention to as well, because when it's coming, FEMA sucks up every single piece of equipment almost, and it becomes a rate war again. So just as spot rates
prepare your customers, have those conversations, prepare your clients.
It's almost as if weather is becoming a function of logistics. Like if you, and I know it's kind of, I'm throwing it way out in there, but it's true. And that has a big part of, what happens to our nerve.
Cat 6.
Category 6 this year. And he also says Trudeau has a rate per mile hidden. Ha ha ha. Yeah. Yeah, and Kelly says no, we don't have a construction shutdown for
Thanks,
construction.
Kelly.
So, I don't.
Today. Thank you so much.
Yeah,
and I
know my crystal ball. Yeah,
go for it.
Well, so the last part, and this is what we'll cover next week, is Shanghai's opening. Those ships are going to start moving. They're going to be heading back across on the Trans-Pacific trade lane. If you read Journal of Commerce, the Pacific Northwest ports are already at peak capacity. They can't handle any ships diverting from Los Angeles. Right, so you're going to find that, and talks have just started again on the West Coast. They were put on hold for a couple of weeks. So the labor talks are ongoing. We've got this surging volume coming across. Jeff hit the nail on the head. We are about to see, probably in the next 6 to 8 weeks, surging volume of all of our ports. So if you've got any shippers that you have on your books, now's a good time to talk about how you handle the delay, the transit times, the appointment times, the equipment. Get ahead of this now. I assume we learned our lesson from last year. We've got a lot more land leased store containers. But if you read Journal of Commerce, we're still a long way out of this. It's a great subscription. But that's kind of where I would land on. Port volatility is going to be, I think, a pretty big story this year, even though rates will be fairly flat. I think in certain port markets, just like we showed you that Houston to Lubbock is going up way above national averages. You'll see the same in port markets, maybe like Seattle to Chicago, Los Angeles to Chicago, Savannah to Chicago, all of those lanes. You'll see there'll be rate volatility at the individual lane level.
Beautiful. Thank you so much, Dean. Another awesome show. Can't wait to continue this data. I'm excited to hear next week on how Shanghai
I can't wait to see what happens next week.
Has been so efficient. They're going to screw us royally. So DJ, take us out of here, brother.
Yeah, they might be sending a flood to us. So get ready, guys. Again, take the information that Dean has shared with us, and he shares with us weekly. And you can't just take it and listen to it. But you gotta, get it to your customers, especially if any of your current clients or customers are having obviously have anything to do with what we're talking about here. But you have to use it. Don't just listen. You got to use it. But again, thank you guys, everybody, for joining us like you do weekly, daily, 9 a.m. till 9:30 Eastern Standard Time. Start your day right with us right here, Sales Chatter Live. You guys are killing me with the screen popping up.
You can't be distracted, DJ.
Thank you to American Logistics, Centurion Trucking, and to everybody for joining us like you do weekly. Don't miss tomorrow. We have Greg on with us to kind of fill us in on what's going on. And obviously next week we'll have Dean and Jeff back on with us. So Jeff will be in a hot seat with us here to tell us what's going on too. So again,
awesome.
Take us out. Dan, you'll love this one. Dale Carnegie. Knowledge isn't power until it is applied. Apply it.
Welcome to the HPLS podcast. Live, relevant, and high performance information.